Why don't we start by asking if that's what you expect to continue? Do you expect us to continue to see interest rates at this kind of level? And if so, is there a way to position the fund to benefit from that, or at least not to suffer from it? Because while high interest rates might not affect some of the companies' operations in themselves, they might affect longer term the way the market values those companies.
So our base case scenario is interest rate is going to stay higher for longer.
Right.
We have been saying this since last year. I think that is likely to be quite true now if you follow some of the central bankers' commentary recently. And on the back of that, it's very important that you invest into a company that are mostly net cash on their balance sheet. So such as some of our most of our company in our fund would be net cash, so that they are not at risk of refinancing at a much higher rate if they are indebted. So this is a starting point. Secondly, the reason for a higher level of interest rate for longer is because inflation is going to be a lot stickier than before on the back of the geopolitical uncertainties, which link to the energy bills going up, mortgage rates going up. At the same time, of course, we still have a shortages of workers. So you would expect rates to stay high for longer. And what it means is, from an investment perspective, that we are very cautious about consumer-facing businesses, in particular if those businesses are exposed to consumer discretionary spending. And I would expect that our pockets or wallets would remain under pressure in the next coming year. So you want to avoid companies that are selling discretionary services or products.